Welcome to CoreLogic's first housing market update for 2019. It looks like the new year has kicked off in a similar way that last year ended, with housing values broadly falling across most regions of Australia. National dwelling values were down by 1% over the month, which was the 13th monthly fall over the past 15 months. CoreLogic's National Dwelling Value Index is now down by 6.1% since the market peaked back in October 2017. The weakest housing market conditions continue to be centred in Sydney and Melbourne, where values have fallen by at least 1% on a monthly basis since November last year. Both markets have seen an acceleration in the rate of decline over the past 3 months, with the rolling quarterly falls tracking at the fastest pace since the downturn commenced. Sydney dwelling values were down by 4.5% over the 3 months ending January 2019, and Melbourne values were 4% lower. The latest results take Sydney dwelling values back to levels last seen roughly 2.5 years ago, while in Melbourne, where the market peaked 4 months later than Sydney, dwelling values are back to where they were in January 2017. While most of the attention is on Australia's two largest cities, weaker housing market conditions are evident across most of the capital cities. Every capital, apart from Canberra, recorded a month-on-month fall in dwelling values in January, and only two capital cities, that's Hobart and Canberra, recorded a rise in values over the past 3 months. While values aren't falling across every broad region of the country, it's clear that even within the areas where values are rising, the market has lost some steam. The only regions where the annual change in dwelling values has improved relative to a year ago are Darwin, where the annual rate of decline has eased from 9.7% a year ago to 3.5%, regional Tasmania, where the annual rate of growth has risen from 4.9% to 9.2%, and regional Northern Territory, where the annual decline of 1% has improved to an increase of 1.1%. The regional markets are generally showing healthier conditions relative to the capitals. The combined regional index was down by 0.6% over the 3 months ending January, while the combined capitals index was down by 3.3% over the same period. 3 of the 7 broad rest of state regions recorded a decline in values over the past 3 months. Regional New South Wales values were down by 1.3%, while regional Queensland values were 0.3% lower, and regional WA values were down by 0.8%. As always, there's a substantial diversity across the capital city regions. Sydney's housing market moved through a recent peak in July 2017 after housing values surged by almost 80% between early 2012 and the market peak. Since that time, values have been falling, declining by 12.3% through to the end of January. The latest falls take Sydney dwelling values back to levels last seen roughly 2.5 years ago. The most substantial falls in home values are skewed towards detached houses, where values are down by 10.9% over the past 12 months, compared with a 6.9% decline in unit values. The better performance across the unit sector is likely attributable to the lower price points, which are attractive to first home buyers. Dwelling values have been falling across Melbourne since November 2017, with the market down 8.7% since peaking. The past 3 months has seen the rate of decline accelerate. In fact, with Melbourne values down by 4% over the past 3 months, this is the largest decline over any 3-month period since our index commenced back in 1980. Weakness in the market is most concentrated across the most expensive end of the market. The most expensive quarter of Melbourne properties has recorded a 12.4% fall over the past 12 months, while the least expensive quarter of the market is down by less than 1% over the past year. The surge in first home buyers since stamp duty concessions became available is likely a key factor in stronger housing market conditions across the more affordable end of the market. Brisbane's housing market has remained absolutely flat over the past 12 months, with a 0.1% gain in house values, helping to offset the 0.5% decline in unit values over the year. The Brisbane market has shown a consistently soft performance over the past decade, with dwelling values rising at the average annual pace of just 1.7%. With values rising at a pace that's lower than inflation and softer than wages growth, the housing market is in a much more affordable position relative to Sydney and Melbourne, where median house values remain $360,000 and $200,000 higher than Brisbane values. This relatively healthy level of affordability, as well as surging population growth and stronger rental yields, should help to keep the Brisbane housing market in a positive territory over the year. Adelaide housing values are up by 0.9% over the past 12 months. Despite the relatively mild pace of growth, Adelaide was the third best performing capital city after Hobart and Canberra, based on the annual rate of capital gains. With a median house value of $464,500, Adelaide is now the most affordable capital city to purchase a detached house. It's the sheer affordability that is likely a key factor in keeping values afloat, along with improving migration rates, falling unemployment, and positive jobs growth. The Perth housing market has continued to work through tough conditions, with dwelling values slipping another 1.1% in January to be down 16.5% since the market peaked in mid-2014. While conditions were showing signs of levelling out in late 2017 and early 18, the decline trend has once again become entrenched and gathered some momentum through the second half of last year and into the first month of 2019. The weaker conditions coincide with a softening in labour market conditions. Local rental markets provide some hope that housing market conditions may start to improve. Perth rents have moved back into positive growth territory after falling by more than 20% since peaking out way back in 2013. Hobart's housing market continues to be the standout performer, at least in trend terms, with dwelling values up 1% over the past 3 months and 7.4% higher over the year. Despite the strong trend, the market is clearly losing some steam, having passed through a peak rate of annual growth over the 12 months ending March 2018, when values were rising at 13% per annum. The pace of capital gains is likely to continue to moderate through 2019 as affordability constraints dampen activity and housing supply starts to respond to the strong demand. After showing signs of levelling out, the Darwin housing market has recorded 2 consecutive months where dwelling values have reduced by close to 2%. The unit sector continues to be the main drag on housing market conditions, with values down 13.2% over the past 12 months, while house values have actually pushed higher, up by 2.3%. Weak levels of housing demand following the completion of major infrastructure projects have left the Darwin housing market suffering a decline of almost 26% since the market peaked in mid-2014. The Canberra housing market is the only capital city where dwelling values are tracking at record highs. Values were up 0.2% in January to be up 3.8% over the year. With a federal election looming and jobs growth taking a pause, we may see the Canberra housing market stall until some certainty returns around labour markets and government policies. Vendors have become reluctant to place their home on the market, with 32% fewer new listings in January relative to the same time a year ago. January can be a hard month to read the housing market due to low levels of activity. However, the recent trend in housing market data has generally weakened over the past 3 months, with the pace of decline accelerating across markets already in their down phase and growth generally moderating in other areas. Tight credit conditions, weakening consumer sentiment, less domestic and foreign investment, and higher levels of housing supply are the primary drivers of the worsening conditions. Advertised stock levels have started the year on a weak footing, with fewer fresh listings being added to the market, while relisted properties continue to mount up due to the slower rate of absorption. CoreLogic listings counts for January show that listing numbers are tracking 13% lower than last year for new listings across the capital cities, while total advertised stock levels are almost 16% higher. The rise in advertised stock is most pronounced in Melbourne, where total listing numbers are 34% higher than the same time last year, and in Sydney, where there's 24% more stock than a year ago. Heightened levels of available homes to purchase inevitably pushes more power back to the buyer. Buyers can negotiate harder. They can take their time in making a purchase decision, and they can be selective in finding a home that's right for their budget and for their lifestyle. Vendors are clearly facing more challenging selling conditions. Vendor discounting rates across the combined capitals have increased to a median level of 6.1% over the 3 months ending January, up from 4.7% at the same time last year, and the median selling time has risen to 44 days, up from 37 days a year ago. The slowdown in buyer activity is evident in the reduced number of settled sales. CoreLogic estimates there were 12.3% fewer sales over the 12 months ending January 2019 relative to the same period a year ago, and transactional activity is down 15.8% from the 2015 peak level of activity. Auction results will become available from the beginning of February. However, we aren't expecting a turnaround in the weak auction results that were evident through late last year. The trend through December 2018 saw clearance rates across the combined capitals reaching a low of 40%. Overall, the January index results as well as peripheral housing data are foreshadowing a challenging year ahead for the housing market. There may be a further dent to confidence as we approach the federal election, and housing finance conditions are likely to remain tight after the hand down of the Hayne Royal Commission report, which is due out in early February. With so much uncertainty in the housing market and the broader economy, it's all the more important to stay up to date with the latest facts and figures from CoreLogic. Stay up to date with our research and our commentary at www.corelogic.com.au.